First of all, I'd like to thank KDI and the organizers of this workshop for inviting me here today. I will be speaking on India economic trends and policy issues. So today I'm going to address 4 specific questions. First, what was the situation pre-COVID? Second, what has been the impact of COVID? Third, in terms of the policy response, is India doing enough? And fourth, what are some of the key medium-term challenges as well? So first, starting with the longer-term perspective on India. So India has followed a process of about 3 decades of gradual reforms. And the left-hand slide shows the overall impact that India has had in terms of its impact on global growth. So the bars on the right show the overall contribution of Asia to global growth. You can see that has risen substantially. And the bar at the bottom in orange shows India's contribution to global growth. Now, this is, of course, adjusted for purchasing power parity or for prices. So you can see on the left that India in 1990 contributed about 5% to global growth. And today, roughly 2018, it contributes about 15%. And on our projections, that contribution will rise over time. And that partly reflects the story on the right side. India, although like the rest of Asia, is aging relatively rapidly, it starts at a relatively young workforce. So the right-hand slide shows the growth in terms of the Indian working age population by 2030. And then the bar on the right shows it's a general trend overall for South Asia. So I mentioned gradual progress of structural reforms. India in 1991 opened up substantially to the global economy with great steps in terms of trade liberalization, and has gradually progressed in terms of structural reforms over the last 3 decades. And that is largely what has spurred its growth. Over the last 3-4 years, they've taken some important steps as well. One was to start with improving how they resolve corporates and others that are linked to insolvency. And that was called the Insolvency and Bankruptcy Code, which was implemented in May 2016. Second, in terms of macroeconomic policies, the Reserve Bank of India adopted flexible inflation targeting in May 2016, and with a headline inflation target of 4% plus or minus 2%. And then in July 2017, they implemented a nationwide goods and services tax. These were some of the big ticket reforms. There have been a lot of other reforms, including easing doing business, which is relevant for all investors in India. And then recently in September 2019, they had a reduction in corporate income taxes. So I already mentioned they adopted inflation targeting a few years ago. And you can see here when they started implementing inflation targeting, in fact, a little bit ahead of the official date, inflation has mostly stayed within the target range. Now, one of the complications in India is that food is a substantial portion of the consumer price basket. It is about 47%. And as economists know, food is subject to substantial supply shocks. So the headline number, which is the number which is kind of in the green, has mainly stayed within the band, though occasionally and particularly recently risen above the band, primarily because of food price inflation, which you can see in red. And you can see it's quite volatile and much more volatile than overall headline inflation. Core inflation, which is inflation excluding food and fuel, has broadly remained within the band. That said, we have to acknowledge favorable supply shocks. First, overall commodity prices, especially fuel, inflation has been quite muted in recent years. And then initially, at least, food prices also aided the process. But some of our research shows, importantly, that inflation expectations have become much better anchored since the inflation targeting framework is adopted, which means monetary policy can have a much better impact. You don't have to go through this slide in great detail, but which explains that India has a very strong external position. This was based on our assessment in 2019 and is available in more detail in the IMF's external sector report. In particular, the current account deficit, in this case, we have current account balance. The deficit narrowed to about 0.9% of GDP in the fiscal year ending March 2020, and we expect it to narrow further. In fact, if you look at the recent data, India has actually moved into a slight current account surplus on a quarterly basis. Capital flows have been volatile, and particularly in March and early April, there were large outflows, but generally they have stabilized more recently, and I'll have a slide later on that. And foreign reserves by end March 2020 had risen to 478 billion, which is a substantial number for a country like India, which is 16.4% of GDP at the end of 2020. Today, they've risen even further. They're about 535 billion currently. That said, before the COVID shock, growth in India had been declining gradually over the last few years. And I'll go into a little more detail in just a moment. And in particular, there was a sharp decline when you consider a proxy for our private domestic demand, which is essentially, in this case, defined as GDP less net exports and government consumption. And that is the green line in the chart there. One of the concerns we have in terms of India before the COVID crisis, and it affects the ability of a country like India to respond to a crisis like COVID, is that it has limited fiscal space. And I think that's best highlighted by the chart on the right, which compares India to other large emerging markets. And you can see that its general government debt was at around 70% of GDP in 2019, which is among the highest of emerging markets. On the left, let me explain the bars a little bit. The blue bar at the bottom is the deficit in terms of the states. The kind of the grayish bar is the center, and the black bar is the general government fiscal deficit. However, one of the lines in the headline there says about transparency. In India, there has been substantial off-budget fiscal activity, so quasi-fiscal activity, which is reflected primarily in its debt numbers, but not fully in its fiscal deficit. So while there was evidence that the general government deficit had been declining over time in India, actually, when you consider this off-budget measures, these quasi-fiscal activities, the decline wasn't as substantial, and then all those measures rose in the previous fiscal year. Again, that's the fiscal year ending March 2020. A second issue, which we think led to stress in the Indian economy, and probably is one of the largest factors leading to stress in the Indian economy, is issues related to the banking sector, which I highlight on the left side, and the non-bank sector overall, and the financial sector overall, which we try to put together on the right side chart. So in India, following the global financial crisis, there was substantial lending to the economy, and that led to many stressed assets, particularly for public sector banks. Those are the banks shown on the far left side, with gross non-performing assets being very high. And you can see the numbers in the red dot there. And that led to weak credit growth, which is the bars below. By contrast, even though NPAs were not low in private sector banks, they were substantially lower than in public sector banks. This led to growth or facilitated growth in the non-bank financial sector. The non-bank financial sector in India is a regulated sector, but with a lighter touch regulation than the commercial bank. Especially after, you may have heard of demonetization, that spurred large growth. Demonetization led to large growth in deposits in the banking sector, which essentially ended up being lent to the non-bank sector, which then lent it out. But starting in mid-2018, there was a default of a large non-bank financial sector. And since that time, there have been stresses for the past 2 years, even before COVID, for the non-bank financial sectors. And broader measures of credit growth, which is the chart on the right, fell dramatically, and you can see that. So what are the key takeaways before COVID? First, gradual progress with structural reforms over 3 decades. There were significant reforms, but more are needed, particularly in terms of land, labor, infrastructure, health, and education, and environment. Monetary policy credibility had improved tremendously. The external sector is very strong, and the central bank, the Reserve Bank of India's balance sheet remained quite strong. However, in terms of fiscal policy, an enhanced framework was needed, as well as consolidation over the medium term, which was in line actually with India's own goals. And also significantly more reforms were needed in the financial sector, including reducing the public sector role in the sector. So moving on to COVID, what is its impact? So the left chart here shows the daily new confirmed cases in India. And you can see how it's rapidly evolved over time. So India actually had a very early and preemptive lockdown. So for a population of 1.4 billion, the lockdown, which was announced by the Prime Minister Modi on March 24th, occurred when India only had about 550 total cases, and that's the total over several weeks. So it was very early in terms of the lockdown. There was hope. Initially, it was announced for 3 weeks. Subsequently, it was extended several times. So there was hope that India would get control of in terms of COVID. And this was particularly important because India has a relatively weak health infrastructure. That said, despite the lockdown, there was initial progress in bringing down the growth rate of COVID cases through the end of April, but the growth rate has essentially stabilized for a period at around 2 to 3% per day in terms of growth of the stock of COVID cases, which meant that since the base was growing, the overall number of daily cases continued to rise, and pretty substantially into June and July. This was a period also where India was trying to unlock the economy. So that was likely a factor in terms of the ability of India to further reduce the growth rate of cases. So even when we did our last projections for India in early June, there were only 8,000 new cases per day. Today, at least a few weeks ago, the number of cases in India exceeded 60,000 new cases per day. There are some signs, and I'll talk in a moment on that, that suggest there could be some positive signs. And maybe immediately here on the right side, we show that at least for some of the largest cities, the tier 1 cities in India, that's Mumbai, that is Delhi, that's Chennai, and that's Kolkata. That's the blue line here. There appears to be some stabilization and reduction in active cases. However, for the second and third tier cities, which include cities like Bangalore, or Hyderabad, which you may know are IT hubs, the growth rate in active cases has remained pretty substantial. So in terms of activity indicators with COVID, of course, people are focusing on very high frequency activity indicators. One are these Google and iPhone mobility indicators. Maybe focus, rather than all of the lines on the left side, maybe on the red line. The picture is broadly similar with others, which is in terms of grocery and pharmacy, you can see the red line plummeting in terms of mobility soon after the lockdown, and then gradually recovering into early June, and then kind of stabilizing in June, July, and even now August. And that's the general pattern we've seen in India, that activity seems to have recovered into June, but then kind of flattened. I think that's a similar pattern we see globally in many cases from the recovery to COVID. The right chart shows what happened with unemployment. This is not an official measure. This is a private sector survey-based measure. You can see the sharp rise in unemployment, both for urban India and rural India, soon after the lockdown was implemented. Rural India appears to have done better, with unemployment rates coming back down to pre-lockdown levels for rural India. However, that is not as true for urban India. And then looking at more standard indicators in terms of consumption and production, on the left side, we have measures such as vehicle sales, also rural wages, and you can see a similar pattern, a substantial fall and then some recovery. The right side shows in red the industrial production, manufacturing industrial production, and the purchasing managers index for services. And again, you can see a sharp plummet and then a recovery, though we see perhaps some flattening recently. And now just to show what happened on the left chart in terms of exports and imports, similar pattern. The comment there, I would say, is exports seem to have recovered more quickly than imports. That explains why it appears that India moved to a current account surplus in the first quarter of the calendar year, as well as 1 month of a trade surplus in India, a goods trade surplus, which is quite unusual for India. But it appears there seems to be now some catch up on the import side, especially of non-oil, non-gold imports. On the import side, of course, India's imports have also been contained because of the drop in oil prices. The right-hand side chart shows what has happened in terms of portfolio inflows, equity in blue, debt in red, and total in black. You can see the sharp outflows and then the stabilization and primarily improvement in terms of equity inflows since early April. Let me just add there, in terms of foreign direct investment inflows, it appears those have remained strong. And along with the improvement in the trade balance is probably what explains the buildup of Indian foreign reserves from about the 470 plus measure to currently about 530 billion in foreign reserves. Moving on to our growth projections. This is the IMF growth projections for India. You can see how dramatically they've evolved since our January this year World Economic Outlook. So that's the pre-COVID outlook. We expected India growth to slow because of the pre-COVID issues I mentioned, especially in the financial sector, but not as dramatically as we now expect it to slow because of COVID. So in April forecast, which was done at end March, as I mentioned, we were quite hopeful that India would be able to contain the COVID health crisis. India was roughly 2 months behind China, and China was successfully able to contain it. So we had only revised down growth for the current fiscal year. That's a fiscal year starting in April to 1.9%, with a rebound to 7.4% in the next fiscal year. In June, we revised down substantially when we saw the COVID health crisis was not contained to minus 4.5% growth. This is essentially our forecast in early June, with a rebound because we are quite concerned about India's ability to contain the health crisis, as well as what we call the scarring effects from the COVID crisis. So only a modest rebound next year to about 6%. For over 2 years, minus 4.5 plus 6, a geometric average only gets you about 1.25% of growth over 2 years, which suggests, and this is a significant issue for India, if our projections are correct, per capita growth in India essentially would be flat over 2 years. The right side just explains how it breaks down in terms of GDP into total domestic demand, exports, and of course imports are negative, but in terms of the GDP, the national accounts number, are negative. Imports contributes positively to GDP. I mentioned the scarring effects. This just shows how we think that's evolved in terms of underlying growth for India, or potential growth for India. And the blue line, especially on the right, shows our current view that the lockdown itself impacted potential growth. Essentially, it was a supply shock. Mostly, we assume it's a 1-quarter supply shock. The second quarter, the calendar year, the first quarter, the fiscal year. And then potential growth gradually rebounds towards potential, gradually because of the scarring effect. So just quickly, there are large downside risks, both externally on the left side, extended global slowdown, increased risk aversion again. We're concerned about protectionism, and of course, oil price volatility. On the right side are the potential domestic constraints. Still, we don't believe the pandemic is contained. The potential impact of kind of the scarring impact from a decline in productive capacity. And then we remain concerned about the two issues, pre-COVID issues, which is the fiscal constraints, as well as concern about the financial sector. So is India doing enough in terms of its response? So let's look at the fiscal policy. As mentioned, fiscal policy has been constrained, and I think that's most reflected in the red bars on the left-hand side of this chart, which shows that at least the fiscal response for India is kind of middling in terms of emerging markets. So this compares the fiscal response in India compared to responses in other large emerging markets. The red bar is the above line or spending and revenue measures. And you can see it's somewhat middling. However, the blue bar, which is the below the line measures, have been substantial in India. And in addition, there have been substantial support from the Reserve Bank of India. So in particular, the RBI has cut its policy rates by, the main policy rate is called the repo rate, by 115 basis points, and the reverse repo rate by even more. Some would argue right now the reverse repo rate is the more binding rate. So the more binding rate has been cut even more. And in addition, has provided substantial other liquidity measures that you've seen globally as well, such as targeted long-term repo operations, which is TLTROs, which is trying to provide liquidity to the most stressed parts of the economy. Our view is in terms of monetary policy, one question, of course, is headline inflation remains above target. We expect, though, headline inflation will come to within the target range and head towards the midpoint of the target. If that is so, we believe there is more scope for monetary policy. I should mention on fiscal policy, we do believe that there is also, despite the fiscal constraints, because of the, this is a major crisis, a once in a generation type crisis, we do believe that in the short term, more fiscal stimulus could be used as needed, particularly to protect vulnerable households as well as firms. This quickly, I won't go into this in great detail, just shows that without the policy response, the impact would have been even larger, and that's the blue bar there. But because of the fiscal policy and monetary policy response, and also the boost from oil price decline, which India has taken advantage of by increasing excise taxes, which has given it more scope to spend on fiscal measures. We believe those measures have all been relatively supportive of growth. India also announced in its policy measures some support for structural reforms. Particularly, they made a comprehensive reform in agriculture to deregulate production, liberalize marketing, and improve pricing. This was a reform that many people believed is long due. That's probably the biggest measure they've taken. They've also taken smaller measures such as further easing FDI, as well as attempts to ease doing business. We think these measures will help medium-term potential growth if well implemented. In the short term, though, structural reforms are not necessarily supportive. Good medium term, but we do believe macroeconomic policy is the main short-term response. And then, as I mentioned earlier, India does still have a long-term, medium-term structural reform agenda. And those are some points I've mentioned before. So finally, to conclude, just 3 slides on some of the medium-term challenges. So one is stress in the corporate sector in India. This partly explains what was happening in terms of the financial sector. For India, it's called the twin balance sheet problem. It led, as you can see on the left slide, to reduce growth in terms of credit to the corporate sector. And that ended up being reflected in slowing growth for India. And while corporate leverage has improved over time, and that's what the right side shows, it still remains high in some key sectors such as construction, and then transportation, communications, and utilities. So that's what the right side is showing. That's the debt equity ratio. And with the line showing, well, the dots showing the medium and the line showing the 25th to 75th percentiles. A second medium-term issue for India is while India has been quite successful in terms of services exports, its manufacturing export intensity has been pretty low. And that you can see India, the blue dotted line at the bottom, much lower than other countries, including Asian comparator countries. And the right side is part of our explanation for that. India's participation in global value chains between 2007 and 2017 is low and has been declining. So we think importantly, and the government is actually announcing policies to try to become better integrated in global value chains, particularly for manufacturing, also services, but particularly for manufacturing. And my last slide is related to climate and pollution. Probably everyone knows about pollution issues in China, particularly in Korea. I think you're aware of it. But I'm not sure everyone is aware that India has some of the most polluted cities globally. In 2019, actually 21 of the 30 most polluted cities in the world were in India. And you can see it is especially true in that north to northeastern quadrant in India, which includes the Indian capital, Delhi. If you've been to Delhi, say in late November, early December, you know it is very polluted. The chart shows the PM 2.5 levels or the level of pollution. So this will be a major factor in the Indian growth, as well as its recovery from COVID, we hope, in the near term. So I'll stop there, and I think Lamin, my colleague Lamin Leigh, will take over.
Thank you very much. Okay, good evening from Washington. First of all, I would like to echo my very good colleagues' introductory remarks in thanking the KDI for inviting us for this to this workshop, and a special personal thanks from myself for being so kind to invite me to make a presentation on Thailand. So my presentation today will be divided into 3 parts. I will briefly describe the economic context, the longer-term economic context, to set the scene and describe how far, Thailand has come in terms of its economic development journey over the years. Then part two, I will move on to describing what our assessment is in terms of the recent developments and also the IMF's June 2020's outlook for Thailand. And then part three, I will devote that to the remainder of the presentation on macroeconomic policies and the challenges that we see for Thailand, moving forward. So let me start, with the longer term perspective. As you can see from this slide, income levels have risen tremendously, since the mid 1990s. And Thailand, you could see, has really, done well relative to an average middle income country. At the same time, you can also see that important strides have also been made on the poverty front. The dot shows that Thailand has managed to reduce the poverty rate substantially since the mid 1990s. So that's basically the overarching longer term story. What underpins this is basically a very disciplined macroeconomic policy framework. And through that they have built substantial policy buffers over the years. And as you can see, public debt has been relatively managed well through a very disciplined public financial framework, and reserves levels have also increased significantly. So a very strong external position. Moving along those lines in terms of the narrative that explains the longer term journey, you would see the chart on your right, where exports of goods comprise nearly half of GDP, while tourism has rapidly grown and now comprises over 10% of direct balance of payment flows, and nearly a fifth of the economy when considering the other non-related services of tourism. The right-hand side is a slightly complicated chart, but let me try to explain, unpack it a bit. It basically shows that the structure of the exports has become more and more diversified and increasingly weighted towards high value added. So you would see exports are highly diversified, and you see the many sales showing Thai exports of many types of goods. And secondly, you will see high complex or high value added, exports, over the years. That said, so that is one aspect of the longer term story. But in more recent years, domestic demand has been relatively weak. You could see the chart on your left-hand side. Public investment has, for all intents and purposes, been relatively flat. At the same time, if you look at it from the point of view of, private investment, corporate profitability has kind of softened, in the last several years. And that has also kind of contributed to, weaker investment. So it's the combination of very flat public investment, partly driven by, super conservative fiscal policy over the years, and the very subdued investment that really explains, the weak domestic demand. So, putting that together, the economy now has exhibited, a structure where you have very high net savings. And I will come to explain what underpins those high net savings. You see the current account surplus compared to its peers, relatively high. Although in the current context, it has kind of narrowed a little bit, in part in the late 2019, driven by trade tensions, the impact of trade tensions on exports, and more recently the collapse in tourism. The chart on your right gives basically a story about net savings, and you can see corporates playing a dominant role and households. We don't have a disaggregated data beyond 2016, but our view is that, given the pattern in the current account surplus, this pattern in terms of high, household net savings, high corporate net savings has mostly played out even in the subsequent years. So what is the overarching story for Thailand? It's a cocktail of two narratives. You could see. Basically, a very strong external position underpinned by a very disciplined, policy framework, and then as a result of that, they've built buffers. But in recent years, it has been really exhibited very weak demand conditions. And those weak demand conditions are explained by various structural factors. So you can see, the pillars that basically contribute to these very high net savings. The part of those high savings is, a combination of a very weak social safety net, contributing to, high precautionary savings. You would also notice that, Thailand is also one of these very few emerging markets, facing very adverse demographics. It's an aging population. Usually, you kind of, many advanced economies face this type of, challenge. Not many emerging markets are in that bracket, but Thailand is one of the few emerging markets having this adverse. And then on top of that, you also have a high household debt, which contributes to constraining, consumption of private of households. And if you recall, I explained the fact that it has become registered a very strong external position. And then the challenge is that because of the relatively shallow, pension and insurance markets, they are not being able to recycle, some of those savings abroad, unlike other countries who have been successful at that. So this is basically the sort of storyline in terms of the longer term and more recent years. Very strong external position, very weak, domestic demand conditions, and you would see very soon how that kind of is translating to, another dual narrative of low growth and low inflation. So that's basically, given that backdrop of structural factors weighing in on domestic demand, you would see that growth has, by and large, underperformed relative to, a number of the peers in the region, and it has lost momentum over the last few years. And you would see inflation also has been relatively low, very subdued, and well below. And for a number of period in the sample, if you look at the chart in the middle, inflation been at below the lower part of the band. And then, of course, given the very strong external position, the currency has, experienced, an appreciating trend, over the last few years. So the combination of structural factors, constraining domestic demand, that then, feeding into, relatively subdued growth and relatively weak inflation or price dynamics. And then with the external position being strong, you see an appreciating currency. So that's, in a nutshell, that is the pre-COVID environment that Thailand was in. So then COVID came, and by and large, as was alluded to earlier on, Thailand is one of the countries that has managed to flatten the virus infection curve fairly successfully. Although it is very, one has to exercise caution in terms of, describing the success at which a particular country, has managed to flatten the curve, because, some countries have been able to do that, and then, a few weeks later, there has been, some spikes here and there. So I say that with caution. The chart on your right, shows tourism arrivals. I mean, here the storyline is clear. Tourism has really, declined, significantly. And it's really an important part of, of Thailand's economy. The authorities have been, the flattening of the curve really has been a function of, the very strong containment measures that the authorities have put in place. They put an emergency decree in place that kind of contain, really has a very strong mitigation, measures. and that has really contributed to in some way, flattening the curve. The state of emergency, we understand, has been extended to end August, while the reopening process has begun. The authorities are, following a very risk-based approach to open the economy, and so far it seems to be, fairly, risk-based and very judicious in terms of how they are implementing the reopening. They are in the fifth phase since July 1 in terms of those reopening measures. Now, on the next slide, I will describe the near-term outlook, our June 2020 forecast relative to the January WEO forecast. As you can see on the chart on the left, the downward revision that we have made to the GDP growth forecast for 2020 is about 10.2 percentage points, which is quite large, driven really by the contraction in exports, but of course on tourism as well. In Q1, GDP kind of contracted by 2.2% in quarter-on-quarter basis, driven by collapse in services, mostly tourism as well. The chart on your left, on your right, shows basically our forecast, the latest our June forecast relative to the January forecast, and you would see that we are expecting a recovery in 2021, but it's really more like a blend of U and V-shaped recovery. So because of the scarring effect, my good colleague mentioned, Dr. Salgado, we see tourism as one of those sectors probably would experience some element of scarring as well. And given that, the recovery is likely to be gradual. I wanted to kind of qualify that, please note that these projections do not take into account the release of Q2 data that was done in the last 24 hours. We are still looking at that. So I wanted to make that clear that that doesn't formally incorporate, as I said, this was the June forecast. So moving to the macroeconomic policies and the challenges, given that backdrop of longer-term challenges, given the backdrop of subdued growth and strong external position, and a fairly successful effort to flatten the curve. The authorities undertook a very multi-pronged policy package in response to COVID-19 pandemic. I think like many countries in the region, it was really fairly exceptional package of measures that they put in place in terms of addressing COVID-19 pandemic. As you can see on the chart, a lot of measures taken. They have taken on fiscal policy, which comprise a lot of measures, which includes, although not shown on the chart, an increase in health-related spending, and then transfers to households, vulnerable households, tax relief to businesses, and then more targeted soft loans to SMEs. On the monetary policy side, the Bank of Thailand cut the policy rate by 75 basis points. And now the policy rate is really at a very low 50 basis points. They've also taken a number of measures to protect, the stability of the financial, system, to support the stability of the financial system by providing liquidity and backstopping, certain segments of the financial, markets. The BOT has undertaken these measures in a timely fashion, and this has helped in terms of stabilizing Thai financial markets. Moreover, the Bank of Thailand has indicated its willingness to intervene as necessary, along with the other agencies. Most of these measures are described in the IMF's policy tracker, COVID-19 policy tracker. So I would, in the interest of time, I would just, very quickly also just run through the financial policy measures. As I said, soft loans provided by the Bank of Thailand to financial institutions to on-lend to, SMEs, exercising forbearance in terms of relaxation of repayment conditions for SMEs, and along those lines of exercising forbearance, suspension of principal and reduction of interest, on debts to special financial institutions. So let me now unpack, that broad policy package into fiscal, monetary, and structural, and explain what we see as challenges facing Thailand. So in terms of fiscal policy, as I said, they have executed a fairly disciplined, public finance, management, underpinned by the fiscal responsibility law. And because of that judicious management of the public finances, they have over the years, created fiscal space. So it's in the context of that fiscal space that they were able to, execute this exceptional fiscal package, which amounted to about 9.5% of GDP, that was announced in 3 phases, with as I said, with targeted support to the healthcare sector and households and SMEs. Overall, based on our assessment, the expected fiscal stimulus in 2020, from these measures is projected to be slightly, less than what the announced package was. The announced package of 9.5% of GDP. As some of the, these expenditures were financed within the original, fiscal year 2020 budget. So the overall narrative on the fiscal side is that Thailand, through very disciplined, public management, framework, has created space, and the debt level is relatively, low. So because of that, we see the need to, just in the context of numbers, debt level is around 40% of GDP, 41%. And we believe that even with the exercise of these exceptional fiscal measures, the debt to GDP ratio will, oscillate around 48% of GDP, which is below the 60% of GDP ceiling in the fiscal responsibility law. So debt stabilizes, after the fiscal stimulus is, unwound later on, and by and large, Thailand has access to, debt markets with low financing costs, supported by ample buffers. So the priorities that we see going forward is basically 3 areas. One, of course, is, given the very weak public investment, program that they have, executed over the last few years, we see room to kind of leverage the fiscal space and front load, the public investment program through this infrastructure push that they have, this Eastern Economic Corridor, initiative that they put in place. So that is one area that, in terms of capital deepening, that we see as a priority in terms of, fiscal policy going forward. Another area is in the area of strengthening social safety nets and improving the targeting of those. They have implemented a social assistance program over the last 2 years, which by and large has addressed some of the, the areas that we have identified. At the same time, it has, it still has areas where it can improve the targeting, of those, of that program. So that's one area we would identify as an area of priority. And then, of course, I highlighted the fact that it's one of these few emerging markets which are with demographic headwinds. So addressing the population aging, given its fiscal implications, both in terms of pension and healthcare spending, and more broadly, the general macroeconomy in terms of, addressing, precautionary savings, will further would further help in terms of addressing the external imbalances. Over the medium term, in terms of addressing those fiscal implications of the aging, at some point, there would, when the economy strengthens, there would be room for additional revenue mobilization program to be able to, raise revenues to finance those aging-related, spending that I mentioned. Now, moving to monetary policy framework, or monetary policy more generally. So Thailand has the monetary policy framework is described on the slide. So basically, it has 3 objectives. One is price stability, keeping inflation within the 1 to 3% range, the new band. Output stability, real GDP is not excessively volatile, and they use the one-day repo rate as the instrument to achieve those objectives. And one area, of course, which is important in terms of their objective function is financial stability. This is an area where they feel that prolonged period of low rates could give rise to financial stability concerns. So it's an important part of their objective function. So if you put this in the context of an augmented Taylor rule, you would have those 3 objectives there, and then it's a question of how much weight they attach to these these objectives. And to maintain financial stability, our advice has been to use macroprudential measures as the tool. So as I mentioned earlier, given the monetary space they had prior, they used it to reduce the policy rate, but now that is reaching a very low rate of 50 basis points. So that raises the whole issue of what do you do with monetary policy when you are reaching the effective lower bound? That itself is a discussion by itself. So I'll leave it there for now. And our assessment is, by and large, financial stability risk, appear contained. Although there are pockets of vulnerability. I mentioned about household indebtedness as an area of that warrants watching as well. Now I'm going to be moving to the structural slide, and that's my last slide. And I had described to you that basically the challenges that Thailand faced was a kind of two narratives, a dualistic narrative of low growth, low inflation, underpinned by structural factors. So to me, to us, basically, the structural challenges is the elephant in the room in terms of policy package that could help Thailand, move from what one could call maybe a relatively weak equilibrium to a much more optimal or maybe more superior equilibrium. So in this slide, I'm going to be describing very briefly what are the priority areas. And of course, many of these areas have been highlighted by the Thai authorities in their Thailand 4.0 and in their 12th National Development Plan, basically designed to propel the economy to high value added sector. Those priorities are basically 3 or 4. Enhancing labor productivity is an area to boost competitiveness. Implementing a pension reform program to deal with the demographic headwinds that Thailand has been facing. So in our view, a pension reform should help to address the unfavorable demographics. The pension system is, the current system that they have is highly fragmented. It has a very low coverage. The coverage of the informal sector is very limited. And it's not very adequate. The replacement rate for some private sector is considered to be about 30%. So it's an important policy priority. And it would help, addressing this would help in terms of, reducing the high precautionary savings and contributing to the external, rebalancing that we have been, emphasizing. The third area, of course, is the high household debt and then the corporate debt as well. And I guess, it's fair to say that the COVID-19 pandemic has laid bare the cost of these pre-existing vulnerabilities posed by high private indebtedness. So we believe that a multi-pronged approach needs to be taken to address this high private, debt overhang. Household debt is about 80% of GDP, driven in part by subsidized credit programs and to some extent maybe, which has weighed on private consumption and poses, risk to growth, or in our technical language, growth at risk. So the private debt overhang could also, to some extent, undermine the inclusive growth agenda of the authorities, since debt distress, is experienced in households that are at the lower, income and deciles. So we welcome the measures that the authorities have taken to address this. They are quite cognizant of this. As I mentioned when I was explaining the Thai authorities' monetary policy framework in terms of their objective function, they are quite cognizant of financial stability risk. So this is an area I think where we see that the authorities are taking measures to address. Finally, COVID-19 impact in terms of the tourism sector. Tourism clearly represents a major economic driver, globally, and is one of the world's top youth employers. Importantly, it's one of the most interconnected industries around the globe, with hundreds of related sectors. A big part of the economy, or significant part of the economy globally, is depending on this sector. And for Thailand, as I mentioned earlier on, a significant part of the economy is related to tourism. So that raises the broader issue about managing the COVID shock and moving the tourism sector to the new normal, or whatever you want to call it, or supporting tourism in the post-pandemic period. Here, basically, I'll just describe 3 questions that we see are relevant in this. How far does the shock extend into the economy and the population? How long will it last? And what are some of the short-term measures that are needed to support the sector? what would be the exit strategy? What would be the roadmap for addressing, for supporting tourism, post-pandemic, and what are some of the transitional issues? So it is important to, in that context, to hear the views of industry and the authorities to address this, and are there any early lessons that we can draw from countries that have already reopened and have designed some, specialized schemes for tourists? And a third question I would say is tourism under the new normal and beyond the medium term. Can the tourism sector transform itself in a skillful way to adjust to this new normal in the longer term? So these are some of the relevant questions that we are asking ourselves here in terms of supporting tourism post pandemic. We are deliberating on these important issues for an economy like Thailand. So to conclude, I have described the historical longer-term journey that Thailand has taken, a fairly successful, economic development story. I have described the recent developments, in terms of the low growth, low inflation, dynamics and a very strong external position. I have described, the authorities' response to COVID-19 and the near-term growth outlook, our June forecast, and how we see the various policy pillars in the near term and what are the challenges. So I will stop here and thank you very much again, and thank you for your kind attention.
Thank you and good afternoon to everybody. It's a great honor to be present virtually at this event of the well-known KDI School of Public Policy and Management. My talk today is about Indonesia, economic trends and policy issues. You see here the Indonesian flag. In Indonesian, the flag is called lofty bicolor red and white. The saying is that the red stands for the human blood and the white stands for the human spirit. Next, please. Next slide, please. Thank you. So here a brief overview of my presentation today. It's organized around the pandemic. The pandemic is a major event, economically, health-wise, and I'm sure history will look at it as a defining event also in Indonesia. But first, let me start with Indonesia before the pandemic. I think many of the themes we will be discussing today were already present. But then I will turn to the pandemic and its impact. And then more forward-looking, I would like to discuss issues related to the recovery and better medium term, that is, reforms for development and growth going forward. Next, please. So Indonesia before COVID-19. Indonesia's post-colonial history starts in 1945. But I will start my presentation really with the Asian financial crisis, which was a watershed in Indonesia, like perhaps in no other place in Asia during the financial crisis. Next slide. Here what you can see is that unlike for other economies affected by the crisis in Asia, the crisis was a watershed. It led to a change in the political system. As you can see here, it was the start of multi-party democracy in Indonesia. It was also set in motion 2 decades of very rapid social progress. And then, perhaps most importantly for our purpose today, it also set in motion reform of policy frameworks. It set fiscal policy rules, an inflation targeting framework, and important structural reforms were set in place. This is the background. Next slide. Here you see some of the social progress illustrated in some details. As you can see, over the past decades, there has been important progress in a number of dimensions, including infant mortality, educational attainments, and access to basic sanitation. The bars here start in 1996, just before the Asian financial crisis, and then you can see the rapid progress over the next 2 decades. The fact that there is little change between the red bar and the orange bar reflects just the fact that the latest observation typically is 2017 or 2018, so a very short time span relative to 2016. Let me mention here something as a background. I think the one noteworthy fact about Indonesia is its very challenging economic geography. Indonesia has thousands of islands. It has several main islands. The economic center is Java. That's also where Jakarta, the capital, is located. Then there's Sumatra, Borneo, Sulawesi, Bali, Papua, part of the island shared with Papua New Guinea, and then many, many more smaller islands. So there is an element of regional heterogeneity and differences in the level of economic development across Indonesia. And if you think about infrastructure, if you think about development, delivery of public services, it's a considerably harder challenge in Indonesia than in a country with a contiguous landmass. Next, please. Let me start with the policy frameworks. And what you can see 2 parts. So Indonesia's policy framework was upgraded in the aftermath of the Asian financial crisis. And it was further refined after the global financial crisis. In the fiscal policy area, there are 2 important fiscal rules that have defined the fiscal policy framework. First, a deficit ceiling of 3% of GDP and a cap on public debt of 60% to GDP. These rules were introduced in 2003. In the monetary policy area, the Bank Indonesia adopted an inflation targeting regime with a flexible exchange rate in 2005. The banking sector, which had suffered heavily during the crisis, was also restructured, and the regulatory and supervisory regimes were overhauled. More recently, the authorities have adopted Basel III standards in 2016. I should also mention that Indonesia has increasingly resorted to macroprudential measures to regulate and steer credit growth and also help with financial stability. Overall, the enhanced policy framework has served Indonesia well. And Indonesia, in fact, is well known today for prudent macroeconomic policy conduct and quite a conservative approach to macroeconomic policies. Until very recently, I should say, and I will come back to that shortly. But if you look on the left-hand side chart, what you can see is that Indonesia has enjoyed relatively high growth. More recently, at around 5%, quite steady growth at 5%, since 2013. One could look at that as a soft landing after the commodity boom that ended in 2011, 2012. And then, as you can see on the right-hand side chart, is Bank Indonesia has succeeded within its inflation targeting framework to bring inflation down, and over the past few years, inflation has generally moved within the target range. I mentioned before that Indonesia is well known for prudent macroeconomic policy conduct, and with the fiscal rules in place, there has been a remarkable decline in public debt from about 90% of GDP in 2000 to about 30% recently. And the deficit has been around 2% of GDP, or even lower in 2018, 2019. In the banking sector, there was substantial progress in reducing non-performing loans after the crisis. 2000 non-performing loans were close to 20%. They are now less than 3%. And the capital to asset ratio increased from 5% to 15%. Next slide. On the external side, and let me weave in here our most recent assessment in the 2020 external sector report, which is really about the external sector assessment of 2019. The external position is assessed to have been broadly in line with fundamentals and desirable policies in 2019. An important reason for that was a narrowing of the current account deficit between 2018 to 2019 below 3%. Nevertheless, and I will come back to that, it will be important to have structural reforms to boost competitiveness to maintain external balance in the future. I think maintaining competitiveness will, among other things, require a higher infrastructure and social spending, and it will require further progress in human capital development. We also see scope in lessening restrictions on FDI and on external trade, in particular on non-tariff barriers. Tariffs actually are quite low. I should also mention, we don't only look at the current account or the exchange rate, we also look at other indicators of the external position, external vulnerabilities. So Indonesia has a relatively strong reserve position. It's within the fund's recommended range of between 100 and 150% of the reserve adequacy metric. And the stock of external debt is relatively low compared to many other major emerging market economies. Nevertheless, and let me go to the next slide, please. There have been, before the pandemic, two broad themes that have defined the surveillance discussion of the IMF with Indonesia, but that have also discussed policy discussions more broadly. One of the issues is weak domestic revenue mobilization. It is, as you can see in the left chart, relatively low compared to emerging market peers. It's below 15% of GDP. This has meant that Indonesia has been constrained in priority spending on infrastructure, education, health, and also social safety nets. The second feature is that financial markets are relatively shallow. So what you can see in the right-hand side chart is a comparison with some emerging market peers. You can see that the Indonesian financial sector is smaller, and as such, it has intermediated less funds from household and firms to investment. These two structural issues have had important implications. In particular, they have, over time, led to a heavy reliance on external financing. So Indonesia has had a current account deficit, but it's not just the external financing. The combination of a lack of domestic capital plus FDI restrictions, which have constrained financing options for investment, have led to a very heavy reliance on portfolio inflows, which have financed the fiscal and the current account deficit. When I say the fiscal deficit, it's because foreign investors hold right now, after a recent sell-off, over 30% of local currency bonds, government bonds, and they also hold a substantial part of government bonds. And Indonesian non-financial corporates hold substantial FX debt on their books. What this has meant is that Indonesia is relatively susceptible to external market pressure and to volatility in capital inflows, which have, and that is a concern in Indonesia, can rapidly lead to large exchange rate changes and more broadly financial market volatility. So external financial stability and exchange rate stability have been key concerns of Bank Indonesia, and I will come back to that. Next slide, please. So against this backdrop, let me now turn to the pandemic, which, as everywhere else in this world, has hit Indonesia hard and has led to major dislocations and to a rapid change in the outlook, which before the pandemic, at the end of 2019, looked solid. We expected another year of growth around 5%, a relatively smaller current account deficit, and we were also hoping for important progress on some of the structural reforms. With the pandemic, everything has changed. And next slide, please. What you can see here, that Indonesia is still in the grip of the pandemic. The pandemic has recently been stabilizing, but it is not quite under control. So if you look at the top left chart, which shows the total number of COVID-19 cases, the slope of the curve has been flattening, but the curve itself is not flat yet. So if you look at the lower left chart, you see the daily new cases, and they show the data by region. And while in Java, which is the island which has seen most of the COVID cases in Indonesia for quite a while, cases have started to stabilize, but not in Jakarta. In Jakarta, like in other cities in the world, the reopening of the economy, which started in late May, has led to a renewed acceleration of cases. And as you can see on the right-hand side chart, that the resurgence of new cases in Jakarta has led to a stall or to a stalling of the progress in activity. So the blue line are the well-known Google mobility indicators, which started improving in around May and through June, but then have been stalling roughly since about July. And then if you look at the policy stringency index, the red line, which is a measure of the containment measures put in place, you can see that Jakarta, the local government, had to reintroduce containment measures to try to get the pandemic under control. So the pandemic, while stabilizing, still is a concern and may require further containment measures. Next slide. And then, as elsewhere, the economy is now in recession. Indonesia has seen, like many other countries, a deep contraction in output, primarily in the second quarter, but then also in the second quarter, and inflation has weakened. So this picture is familiar, like in many other countries. Next slide, please. But just look at the very high frequency. What we can see is that the economy rebounded in June, like in many other emerging market economies. On the left-hand side, you see the manufacturing PMI. On the right-hand side, you see the export side. Now, an important question, of course, will be in the third quarter whether the rebound, the activity will recover further, or whether the stalling, the renewed introduction of containment measures, and whether the continued relatively high and still growing rapid new cases, whether that will be a setback to the recovery. Next slide, please. So if you look at our forecast, these are still the June RIO forecast. We will probably be a bit more pessimistic. So we expect a downturn, a big change from the 5% growth that Indonesia has seen over the past few years, quite stable. We now see a contraction in 2020 and then a relatively strong rebound. What is noteworthy on this in this table is much bigger fiscal deficit. And let me now come to the policy response to the pandemic. Next slide, please. So the pandemic, of course, has led to unprecedented times and to an unprecedented hit on the economy, and the authorities have taken unprecedented measures. There has been a substantial fiscal response with 4 supplementary budget packages in a very short sequence. In total, the packages amount to around slightly over 4% of GDP. That is additional spending in response to the pandemic. In terms of fiscal impulse, we have estimated so far that it's roughly 3.5% of GDP over 2 years total. In total over 2 years. I should mention that policy response has required a radical change in the fiscal framework. The 3% deficit ceiling, 3% of GDP I mentioned earlier, had to be suspended for 3 years from 2020 to 2022. And in terms of the packages, I think they include many of the measures we have seen elsewhere, including food aid, cash transfers to affected households, unemployment benefits in workers in the informal sector, capital injections to state-owned enterprises, and credit guarantees, mainly with a view to keep small and medium-sized enterprises afloat. Next slide, please. But the unprecedented measures go further. First, let me hear measure 2. Bank Indonesia is now allowed to purchase government bonds. Before that, it was banned from purchasing government bonds. It could only acquire T-bills as required for open market operations. And thirdly, also in a presidential decree to put in place in a short time, was that there have been important measures taken to prepare for possibly rough times in the financial sector. In particular, the Bank of Indonesia is now allowed to fund bank restructuring in times of need, should these be needed, and several elements of the crisis framework that where reforms have been prepared but have not been enacted, have been enacted overnight so as to be ready for rougher times in the financial sector. Next slide, please. So looking forward, it will be important for Indonesia to prepare for the recovery. And while looking into the recovery and making sure that the economy rebounds from the pandemic, and to avoid scarring effects from the pandemic, it will be important not to forget medium-term reforms for a better medium term. As mentioned before, there are important areas of construction, so to speak, in economic policy, on the revenue side, in the financial sector, and so on and so forth. Let me mention a few here. So if you look at I temporarily lost access here to my screen, but now I have it again. What you can see, the big chart on the left-hand side with the important fiscal support, a key challenge over the next few years will be to bring into place the fiscal adjustment needed to return to stability and maintain debt sustainability while also supporting the recovery and growth. We think Indonesia has relatively limited space, so should the pandemic turn out to be worse and more is needed, partly what may be needed are more targeted measures. But at the same time, there are also important medium-term challenges to keep in mind. And what you see in the lower left-hand side, right-hand side table is in particular the challenges on the human capital side. So if you look at the contribution of labor to growth in a growth accounting exercise, is despite quite steady population growth, steady labor force growth, the contribution of labor has declined over the past few years, an indication of the challenges needed to maintain steady human capital development. Next slide, please. Let me then come here. Here what we see a key challenge to support both the recovery, to come back to the fiscal rules, which have only been suspended temporarily, is a medium-term revenue reform. And we really see that Indonesia, for the next step and advance further, will be more. What will be needed is more priority spending on infrastructure, education, health, and the social safety net. Further phasing out of energy subsidies could also help on the fiscal side. And finally, Indonesia, while there have been important market reforms after the Asian financial crisis, with some reduction of the role of state-owned enterprises, state-owned enterprises still have play a prominent role in the economy. They can be a drag. They can be a limit to competition, and further SOE reform would be helpful, in particular in combination with an easing of restrictions on foreign investment. Next slide, please. The other challenge will be to adjust the financial sector support. As elsewhere, Indonesia has put overnight place support measures, in particular for credit to small and medium-sized enterprises. They have been large. In particular, they have been included measures that facilitate credit restructuring, but eventually the costs will have to be borne, and the risks or the potential buildup of financial sector risks related to increased credit risks will have to be managed. Next slide. Sorry, next slide. Let me just mention here another, besides the medium-term revenue reform, another important area to finance growth and development more organically with less dependence on foreign capital portfolio inflows will be financial sector development. That will include strengthening the regulation in the banking sector, including strengthening financial stability, the regulatory regime, but then also developing capital markets. Measures there, for example, include building and developing a yield curve. And then, most importantly, as mentioned, or also importantly, reduction in geographical barriers to financial development, bringing financial development outside of Java and Sumatra to some of the other islands, include access to various forms of payments other than cash, access to banks, etc., etc. And hopefully with these reforms, eventually, with increased per capita incomes, stronger savings, there will be more long-term financing, and the digital infrastructure, which can really be helpful in a geographically challenged country like Indonesia to build bridges and allow for a much faster and more efficient growth of the digital financial infrastructure needed for more financial inclusion, for bringing the savings to investment all over Indonesia. Next slide, please. Finally, let me mention here in 2018, the fund and the IMF and the World Bank held the annual meetings in Bali, Indonesia, and the previous Indonesia team issued a book that discusses many of the medium-term reforms for Indonesia, and the book is called Realizing Indonesia's Economic Potential. So for further interest, if there is further interest in Indonesia and some of the challenges, go ahead. I can only recommend this book. So let me stop here, and thank you very much.
Okay. Well, thanks very much for having me. It's a real pleasure to present at the KDI workshop on ASEAN and India macro policy development issues. I'm going to present on Malaysia. And I will, if you go to the outline, yes, thank you. So I will present on first, I'll give you a long-term perspective on Malaysia's economic success. I will focus more on the success. And then I will talk about the immediate macro context pre-COVID, what was the situation like? And then after that, I will discuss the impact of the COVID crisis. And I will conclude with the very brief remarks on the long-term challenges in Malaysia. So if you move to the next slide, please, I will start by giving you a long-term broad brush on Malaysia's economic achievements as of the eve of COVID. Next slide, please. So as you see, Malaysia over the past few decades has had a very strong economic performance. And this chart summarizes it by showing the growth, inflation, and external sector performance represented here by the current account. So on average, growth has been just short of 5% since after the Asia financial crisis. And if we take out the years of the global financial crisis and the euro area crisis, growth has been close to 5.75% over in the past 2 decades. And at the same time, inflation has been low and under control, averaging about 2.1% over that period. And at the same time, Malaysia has had a strong external sector performance with substantial current account surpluses that have averaged about 8.5% over the past 2 decades. And next slide, please. This strong performance has helped generate very strong income growth and has helped reduce inequality. So you can see on the left-hand side chart that per capita income in Malaysia has been steadily growing since the 1970s, and it has really taken off after the Asia financial crisis. And the gap with high income threshold, as measured by the World Bank, has narrowed substantially over the past 2 decades. And this is an important threshold for the authorities because they target to reach high income status in the midst of this decade, the 2020s. This very strong income performance has been underpinned by a strong labor market performance. As we can see on the right-hand side, labor force participation has been slowly growing over the past 15 years or so. Employment rate has been steady and strong, and unemployment rate quite low. Performance that is much favorable compared to OECD average. Next slide, please. So this next slide, yes. This strong economic performance was in great part driven by the external sector. And in fact, exports have risen significantly since the Asia financial crisis, from about 40% of GDP to reach close to 70% of GDP at the eve of the pandemic. And at the same time as exports were growing, imports were growing as well, partly because greater incomes were generating greater domestic demand on consumption and investment side, but also because exports were becoming more and more diversified. And I'll come to that in a minute. And there were hence import demand generated through the export sector. This external sector performance was not just typical to Malaysia. It was more broadly a phenomenon in the ASEAN countries. And in fact, we see on the right-hand side that as global trade was growing, and Malaysia, as openness in Malaysia kept on growing, as a share of total ASEAN trade, it was declining slightly because the ASEAN countries themselves were also becoming more and more important trading partners with the rest of the world. And this message comes more clearly in the next chart. Next chart, please. Where we see that the share of ASEAN trade in the world increasing steadily across the past 3 decades. So the pie charts represent the total ASEAN trade and their relative size represents the growth of ASEAN trade in over those 3 decades. So between the 90s and the 2000s, total ASEAN trade increased by about 7%. But between the years of 2000 and the past decade, the 2010s, that has increased by 20%. So the volume of ASEAN trade has increased by 20%. And most of that has been driven by Vietnam. But Malaysia also has been a steady share of this increased ASEAN trade over the past few decades. Next chart, please. So as I mentioned earlier, diversification was a big story for Malaysia in the early decades. And you can see on the left-hand side that diversification has started steadily, since the 70s as trade openness picked up in Malaysia. And if you can see on the right-hand side that the diversification meant a move away from commodity exports towards manufactured goods, and in particular electronics and electrical equipment. So whereas in 1975, electronics and electrical equipment were only about 5% of exports in Malaysia, this share rose steadily and peaked at nearly 62% in the year 2000. And since then, other manufactured goods have also picked up. I can name in particular the light manufacturing industries associated with pharmaceuticals, and one of the the star performer in recent months has been the glove making company, where Top Glove, whereby the demand was very significant because of the crisis. So this diversification is really part of the story of the success of Malaysia, and other countries always come to us in the Malaysia team to ask, how can you tell us a little bit about this story, and what was the driver of that diversification. And one story behind it was the availability, the connectivity that Malaysia had with the rest of the world, and I'll come back to that later. But before that, let's turn to look at FDI. Next slide, please. And you can see. Oh yeah, so this is a slide that I changed, but here the slide that you see shows total net foreign direct investment to Malaysia. So this is FDI into Malaysia, netting out the FDI that went out. I had changed it, but unfortunately I cannot show my screen. But if you can imagine that chart, and if you can imagine that it's showing, instead of net FDI, just total FDI inflows into Malaysia, then the magnitudes are much, much greater. And in fact, on average, over the past decade, Malaysia has seen FDI in excess of 10% of GDP. And it's coming from the other parts of Asia, from Japan, from other parts of East and Southeast Asia, as well as from Europe and from the United States. Next slide, please. So as I mentioned, the part of the success of Malaysia and its success as diversification has also been linked to its closer integration in global value chains. And so Malaysia today is an important trading partner, both on the export and import side, for many, many countries, both within the region and outside the region. And here we see the main trading partners. So you can see China and Singapore are on the charts, but also the European Union and the United States. So this is kind of a broad brush of Malaysia's economic success over the past decades. Now let's focus. Next slide, please. Let's focus on the specific macroeconomic context that was prevalent at the onset of the COVID crisis. So next slide, please. So if you look at this slide, you can see that Malaysia entered the pandemic with relative economic strength. So zooming in on growth and inflation and unemployment in the past decade, we see that growth was robust, although slightly declining over the past couple of years, and unemployment was on the decline as well. And as I said earlier, inflation was low and relatively stable. And you can see that in the middle panel, the current account surplus, which was very strong in earlier years, was still positive, but had declined. And this is thanks to rebalancing of the economy towards more domestic demand as incomes prospered. And the last chart is there to show you that Malaysia had been recipient of significant inflows, portfolio inflows, both on equity and bond side. And this was both a strength and a vulnerability, because it had been because of its increased openness to capital flows, it had been susceptible to external global shocks over the past decade, but it had weathered them successfully. And in fact, some of the internal shocks that Malaysia had suffered in the years right before the COVID crisis were the 1MDB scandal that exploded in 2015 that undermined investor confidence. And there was the historic election in May 2018 that for the first time led to a change in government that happened peacefully. So there was a bout of uncertainty immediately following the results of the election that was managed very well by the authorities before things stabilized again. More worrisome were the external shocks that Malaysia had suffered during the past decade. And I can name among those the oil price decline in 2014-2015, then the external shock associated with the so-called taper tantrum, and also the impact of the US elections on global capital flows. And all of these shocks have caused significant capital outflows, which we can see in that chart on the right-hand side. But Malaysia rebounded and capital flew in after that, and we can see that there was no significant growth impact on the left-hand side from these shocks. Next slide, please. If we consider the policy side, Malaysia entered the COVID crisis, if you will, with ample monetary policy space. This is because the policy rate was at 3.25% at end 2019. And inflation expectations were low and stable. And on the financial sector side, the situation also looked pretty good. Banks were well capitalized, profitable and liquid, with the regulatory capital to ratio in excess of 18% and the tier 1 capital ratio in excess of 15%. And liquidity coverage ratio in excess of 140%. So financial sector was stable, risks were under control, and credit growth had declined from its double-digit levels of earlier in the decade, as you can see on the right-hand side chart in this slide. Now, of course, there were pockets of vulnerability in the system. And in particular, we can think of household debt, which is relatively high in Malaysia, and largely because of mortgages. And but they were, under control, and the central bank was closely monitoring the situation in the real estate market. And on the positive side, most mortgages were being paid actively, and the average LTV rate for outstanding mortgages was around 58%. Another vulnerability that Malaysia had going into the crisis is the high share of short-term external debt. But again, here there are compensating factors. The public debt is denominated in ringgit, and the private debt is largely, owed to mother or companies. It's intercompany borrowing, and so this is relatively stable borrowing. So some vulnerabilities, but some compensating factors as well. Next slide, please. If we look at the fiscal side, on the fiscal side, the policy space was more limited. And here, the reason is that the budget had been running deficits in recent years, although these were on a declining trend. And the federal government debt had been increasing. However, it remained below the self-imposed limit of 55% of GDP on federal government debt, which is the anchor of fiscal policy in Malaysia. So there was some buffer there vis-a-vis the debt limit at the eve of the crisis. And why was Malaysia in this position? Well, you can see that on the right-hand side, and my colleague Thomas pointed out to the same case in Indonesia, and you can see Indonesia and Malaysia are right next to each other on the rightmost part of that chart. The tax revenue ratio in Malaysia is really, really low, just like the case in Indonesia. It's under 12% of GDP, and it has been at such low levels for several years now. It's among the lowest in large ASEAN countries, and it's much, much lower than OECD average of 25% of GDP. And hence, the revenue generating capacity in the country has been really low, whereas the spending needs have been, I wouldn't say significant, but have been there, and hence we ended up having deficits. However, next slide, please.
Dr. Choueiri, I'm sorry for the interruption, but for the timekeeping purposes, kindly note that 5 minutes are remaining for your presentation.
Okay, I'll try to speed up through the rest. Thank you. So, despite the fiscal policy space being limited, Malaysia has no problem financing the deficit. There is a high interest of non-residents in holding MGS, as you can see on the right-hand side, and at very reasonable price, with the yields being relatively low, which is shown on the left-hand side. So next, please. Next slide. So now we turn to the the incidence of COVID. If you go to the next slide, please. So as you can see, Malaysia was not spared by the COVID crisis. The left-hand side chart shows the new case and we see that increasing significantly in March, which has prompted the government to introduce what they call the Movement Control Order, which is the Malaysia version of strict lockdown. And we can see that indeed it worked, because the Move It app, which is kind of a local location app, shows that movement has decreased significantly. And this movement control order was successful at containing the spread of the virus. And in May, it has allowed the country to reopen slowly. And today, the virus seems more or less under control, and the economy is slowly recovering, functioning normally. Compared to the other ASEAN countries, which you can see on the other charts, the incidence of the virus in Malaysia was not too bad, but not great either. Next chart, please. So I will go through the next two charts very, very quickly. Basically, these show the impact of the crisis on the economy, and it has been indeed very large, particularly in the second quarter, on manufacturing activity, on unemployment, which is historically high at 5.3% in May. Next slide, please. And a significant impact on exports. Next slide, please. On exports and on retail sales. And we can see a really sharp drop, particularly in the second quarter in retail sales. Next slide, please. So what does that mean? That means that Malaysia is going to see its deepest recession in years in this year, 2020. In June, when we were finalizing, well, actually, this was in May, we finalized the June WEO projections, and we were expecting growth to decline by 3.8% of GDP. But since then, high-frequency indicators have shown that April and May were really difficult months. And so Q2, indeed, the data that was released last week turned out much worse than we had projected back in April, when we didn't have the high-frequency data. And so it's likely that the recession is deeper than what we were projecting in June. So with, probably even more impact on unemployment and incomes. Next slide, please. The policy response has been appropriately targeting the weaknesses in the economy. There was a very significant fiscal policy package totaling 20% of GDP. However, in terms of direct fiscal measures, they were only 4% of GDP. These were cash transfers and wage subsidies. And the remaining 16% of GDP were more below the line measures in terms of delaying some taxes and supporting government guarantees for Bank Negara lending schemes and enhancing existing Bank Negara lending schemes. But in addition to fiscal policy, monetary policy has provided a lot of support, and the policy rate was decreased by cumulative 125 basis points to date this year. And it, as a historical low, it's now at a historical low of 1.75%. At the same time, there was depreciation to accommodate capital outflows. There was significant capital outflows in March. There was a global shock on Malaysia and the other emerging markets, but since then, the situation has stabilized. So let me just conclude briefly. I am very aware that I went overboard over time. So let me just conclude, if you can go to the next slide, please, by very brief remarks on the longer term challenges. Next slide, please. So at the beginning, I talked a lot about Malaysia's achievements and successes over the past decades, but I didn't talk about the challenge that has underpinned that decade at the same time, and which is stagnating productivity, and you can see it very clearly in the left-hand chart. So it's very hard to forecast what kind of economy the pandemic is going to leave us with, whether it's in Malaysia or the rest of the world. But one thing for sure is that given stagnant productivity in Malaysia, this issue is likely to come back to haunt the authorities, and there will need to be significant changes, important reforms on the education level, and to encourage innovation and technology adoption to lift productivity and to allow Malaysia to regain rapid per capita income and reach high income status. And underpinning these reforms, what is very important is for Malaysia to stay the course on the governance reforms that were started by the Pakatan Harapan government, because these will underpin a better functioning of the economy. I'll stop there. Thank you very much.
Thank you very much. I would like to thank KDI for organizing this excellent event and for inviting me. I'm going to talk about Singapore's current economic developments and the outlook. But before I go there, let me just say a few words to lay the ground on where Singapore stands. Singapore is a country of about 5.7 million people. It is situated at the southern tip of the Eurasian Peninsula. And of these 5.7 million people living in Singapore, about 3.5 million are Singapore citizens, and another 500,000 are permanent residents. So you can already see a defining feature here of Singapore, which is its openness. There is a large degree of foreigners working and living in Singapore. And openness doesn't stop there for Singapore. Singapore is a very open economy when it comes to trade. Both imports and exports as a share of GDP are exceptionally high in Singapore. And this, of course, is natural, given Singapore's position at the Straits of Malacca, where a lot of the world trade goes through. So Singapore has a large maritime sector, it has a large harbor, it has a large airport that serves as a hub for part of the region. And I'm saying all this because this will be, of course, important to keep in mind when we think about the impact of COVID-19 on Singapore. The future of being a very open economy matters quite a bit here. Singapore is also an important financial center. Singapore intermediates financial flows from around the world, especially advanced economies, to developing Asia. And again, that matters also in the COVID-19 context. Looking at Singapore's long-term economic performance, it has been impressive. Singapore has had one of the fastest per capita GDP growth rates in the world, along with success stories such as Korea and Taiwan. And to give you an idea of the per capita development, in the year 2000, Singapore's per capita GDP was about $24,000. It is now around $65,000, which places Singapore among the richest countries in the world. At the same time, Singapore has been successful in the last decade in reducing inequality. This is after an increase in inequality in the 2000s. And I mention this because this, of course, globally is a big issue now, and we've seen in most advanced economies an increase in inequality. So this speaks to the policymaker focus in Singapore on this issue. What have been long-term drivers of Singapore's success story? There are many, but just to name a couple, it is that are related to macroeconomics. Macroeconomic stability has been ensured by the authorities while having a very strong micro focus when they, for example, implement fiscal policy. Policy frameworks in Singapore have been very strong. Thinking here of fiscal policy, where there's a clear fiscal rule that does not allow for deficits over the political cycle. Monetary policy, which is focused on the exchange rate, has a lot of credibility. And the financial sector has been robust, partly due to very good supervision. And that has allowed Singapore to withstand shocks in the past. With these introductory remarks, let's move into current economic developments. And I would like to start off with talking about the COVID-19 developments in Singapore, because as in other countries across the world, this has been driving a lot of the economics, of course, in the situation. On the left-hand side, you can see the daily new cases in Singapore. And as you see there in January, February, into early March, Singapore initially saw very low COVID-19 case numbers. And this was while maintaining relatively limited restrictions domestically. Singapore did close to a significant degree its borders, but within the country, there were really fairly limited restrictions. But then in April, there was a sudden surge in COVID-19 case numbers. And this was mostly among low-wage foreign workers that work in areas such as construction. And most of these workers are housed in dormitories, often with 10, 20 people in one room. So it was very difficult to establish social distancing there. So the virus was spreading in these dorms. The authorities in Singapore reacted with stringent containment measures on April 7. And this so-called circuit breaker shut down parts of the economy. A lot of construction sites were closed down. Restaurants were closed. Of course, the entire tourism sector was for the most part closed. And these measures were in place until June, when some of the measures were relaxed. And then there was later in June another relaxation as COVID-19 case numbers kept falling in Singapore. We are now in the so-called phase 2 of reopening in Singapore. And most activities have resumed. There are still some restrictions to ensure safety. Mask wearing, for example, is required. But overall, a lot of activity domestically has resumed. At the same time, Singapore's borders remain mostly closed for short-term visitors, with a few exceptions. For example, Singapore agreed to have a green lane channel with Malaysia, and there recently also has been an agreement with Japan. Still, of course, the tourism sector, the retail sector in Singapore, which is very dependent on tourism, numbers are way below pre-COVID-19 times. On the right-hand side, I included this chart just to point out that most of the COVID-19 cases in Singapore were concentrated among low-wage workers in dormitories, as I mentioned. This is the blue part of the bars here, and since you can't really see the other colors, that shows you this is really the dominant demographic where the virus was. Despite relatively high incidence of COVID-19 cases in Singapore relative to its population, the death toll or mortality in Singapore has been relatively low. I think there are three reasons for that. First of all, as I showed you, most of the cases in Singapore were among low-wage foreign workers who tend to be a bit younger, most of them healthy. And we know that that demographic is a bit less vulnerable to COVID-19 than, for example, the elderly or people with pre-existing conditions. So that probably contributed to the low mortality rate in Singapore. Secondly, Singapore has been extensively testing for COVID-19. So the denominator of the mortality ratio is higher in Singapore, similar to other countries that have relied on extensive testing, for example, Korea, of course. And finally, I think it's important to recognize that Singapore has excellent healthcare, and the government had an organized and strong response, which also has helped to keep mortality low in Singapore. Moving on to economic development. Singapore's economy is very hard hit by the virus. In fact, it is going through the most severe downturn since the country's independence in 1965. We are projecting a contraction of 6% for this year. And you can see here growth rates going back to the 1980s for Singapore on the chart. Singapore was not as badly hit in the Asian financial crisis or the global financial crisis as it is by the COVID-19 shock. What I also would like to point out here is that in recent years, growth rates in Singapore had moderated compared to history. This is simply a function of a slower growth in the labor force, slightly more restrictive immigration rules since about 2011, 2012, and the economy now, of course, as being one of the richest countries in the world, is at a fairly mature stage. So there was already in the last 10 years a moderation in real GDP growth rate. For Singapore, we have Q2 GDP data. There was not a big surprise. The numbers looked very bad, as in many other countries. In year-on-year terms, in the second quarter, the economy contracted a bit more than 13%. On quarter-on-quarter terms, this was close to 43% seasonally adjusted, the contraction. But as I mentioned, this was not unexpected because the peak of the containment measures fell into the second quarter. So parts of the economy were simply shut down. For example, construction sites lay mostly idle. Also, retail services, tourism, etc., was effectively shut down. So no big surprise that the second quarter was fairly bad. But there is substantial variation in the degree of damage across economic sectors. Let's turn to some high-frequency indicators to take a closer look at this. First of all, there was a cluster, or is a cluster in the economy that is particularly hard hit. I already mentioned construction. A lot of construction sites had to be shut down because that's where a lot of the foreign low-wage workers are working that were hard hit by the virus, and they were isolated in their dorms to stop the spread of construction stuff. Anything travel-related, of course, took a hard hit, as in other countries. And on the services side, any customer-facing services were affected by the containment measures. I'm thinking here of activities such as retail and food and beverage. Together, these sectors account for about 12% of Singapore's economy. However, on the services side, it was not all bad. There are some services which are often called modern services, such as finance or information technology related services that were holding up quite well. What we also see in Singapore is that the production side of the economy, manufacturing, has done better. This is a theme that we see in many countries, and Singapore here is no exception. Singapore has also benefited from the product mix on the manufacturing side that it has. There was a surge in the production of pharmaceutical ingredients in Singapore, and also biological products. This was, of course, related to COVID-19. Also, the electronics industry, which is important in Singapore, did well, as it did in other countries, as certain parts of electronics were benefiting from increased investment in that space, given, for example, requirements to socially distance. So that area is similar to other countries as well. And we see that in industrial production. We also see that in exports. The chart on the right-hand side, you can see that Singaporean exports were actually growing COVID-19. When you look at more soft data on the manufacturing side, for example, purchasing manager indices, we had a contraction for 5 months, but then since June, PMIs in Singapore have turned positive or have turned to expansionary territory. So that again underlines that the manufacturing production side in Singapore is doing better than some of the affected services sectors and construction. However, looking at the details, even on the manufacturing side and some of the surveys, the PMI, the component related to unemployment, is not doing so good. And I'm showing you here on the next slide unemployment indicators. On the left-hand side, you see the unemployment rate unemployment rate in the second quarter rose to 2.9%. This is from 2.4% in the first quarter. And this includes both foreigners as well as Singapore residents and citizens. When we just look at the citizens and the permanent residents, the unemployment rate is higher at 3.9%. And most jobs were lost in vulnerable services producing sectors, especially retail and transportation. Keep also in mind that the increase in the unemployment rate and the drop in employment was despite substantial government support for employment. To name the main schemes, the authorities in Singapore created a job support scheme, which provides wage support to employers, helping them to retain local employees. Just a couple of days ago, the Singapore government announced an extension of some of these benefits well into next year. Singapore also reacted early on by strengthening active labor market policy measures and training programs, especially for people that were laid off and for recent university graduates. These measures are intended to help workers to adapt to the changing job demands and also reskill them for changes in the economy that are likely as a result of the COVID-19 shock. A few words on the property sector in Singapore, because this is a very important sector. It is a significant part of the economy in Singapore. Before I go into the data, let me just explain a bit about the property sector in Singapore, because it is a fairly unique setup. In Singapore, about 80% of locals live in housing that is called HDB, which is planned and provided by the government, and then Singapore citizens have the right, meet certain conditions, to buy these properties. So that's HDB housing. There's also a private housing market in Singapore, which is mostly high-end properties, and foreigners are in the private housing market. So a relatively unique setup compared to other countries. When we look at property price developments in Singapore, we don't see a drop at this point, despite severe economic contraction. And also some of the laid off foreigners have left the country, yet we don't see the impact yet on property prices. Now, this is not to say that we may not see that going forward. Property prices often react to a lag. There is inertia in that market, but so far so good. One factor here probably has been that we did not see a big run-up in property prices in Singapore going into this crisis. This was probably partially due to the use of macroprudential measures by the Singaporean authorities to limit property price increases in Singapore. The story is a bit different when we look at commercial property. Retail had been under pressure in many countries, also in Singapore, with the longer term because of the shift to e-commerce. And with the shutdown of many physical retail properties, we have seen an increase in empty and not occupied retail space. You can see that on the right-hand side in the chart. So going forward, this is something to watch. There is some rental relief for SMEs, but of course the sector is suffering. Moving on to inflation. You get here the longer term view on inflation from 2012, and you can see that inflation has been under control in Singapore. Monetary Authority of Singapore has a lot of credibility, is well established, and has kept inflation in check. Recently, inflation has turned negative. That applies both to headline inflation as well as core inflation. Core inflation in Singapore is measured a bit differently as in other countries. It excludes private transport and accommodation. But the takeaway here is inflation is low, it's turned negative. Looking ahead, we expect inflation to remain subdued. There are no big price pressures on the horizon on the external side, as well as the domestic side, with slack in the labor market that I showed you, and also contraction in overall economic activity. There will be overall slack. Moving on to the government's policy response to the COVID-19 shock. And of course, I mean here the economic policy response. Singapore was in a fortunate situation of entering the crisis with substantial fiscal space. I mentioned it in the beginning that Singapore has these big fiscal buffers. And this is the result of building these buffers over decades. And Singapore actually, in net asset terms, has very substantial net assets. And fiscal rule that doesn't allow deficits over the political horizon plays a big role, and very long-term forward-looking policies. So Singapore was in the situation of having substantial fiscal space, getting into this crisis. The authorities were nimble and quick in responding with a substantial fiscal package to the downturn. You can see here, Singapore had about 21-22% fiscal stimulus. A lot of it was actually direct fiscal measures, so above the line fiscal measures at a bit more than 15 percentage points of GDP. And that makes the Singaporean fiscal package one of the largest in Asia. The fiscal package in Singapore was focused on providing cash support to businesses and households to get through the containment measures and weather the COVID-19 shock. So it was very tailored to the specific shock. Key components of the fiscal package were wage subsidies to help firms keep their workers employed. There have also been property and income tax rebates to help cash flow issues for businesses. And finally, an important component were direct cash transfers to households with a strong focus on lower income households. Singapore also created a package to ensure that especially small and medium-sized enterprises can access affordable credit. The way the Singaporeans designed this was that the government provides a 90% guarantee for new loans, but 10% is actually retained by the banks or the finance companies that make the loan in order to keep the incentives for good underwriting. The Monetary Authority of Singapore then provided funding for lending type facility that allowed banks and finance companies to access cheap funding to on-lend to the SMEs. So there is a subsidy component to create the cheap funding. And finally, the banks are the ones who make the lending decisions, and they retain, as I mentioned, 10% of the credit risk. So that hopefully should ensure that they do their normal credit assessment and maintain their underwriting standard. Monetary and financial policies have also been supportive and focused on ensuring stability. A few words on Singapore's monetary policy framework, because again, it's fairly unique. Singapore has an exchange rate centered monetary policy. What that means is that Singapore targets a level for the nominal effective exchange rate of the Sing dollar compared to its trading partners. It then sets a rate of appreciation and also band around that target midpoint for the Singapore nominal effective exchange rate. And this framework, when the exchange rate depreciates, that is equivalent to an easing, and conversely, an appreciation would be equivalent to a tightening of monetary policy. So on March 30th, the Monetary Authority of Singapore adopted a 0% annual rate of appreciation of the exchange rate, and it reduced the midpoint to the prevailing level at the time of the Singapore dollar nominal effective exchange rate. It also, so that wasn't easing. It also, through its money market operations, kept ample Sing dollar liquidity in the system to support banks in their lending. And we see the effect in declining short-term and long-term interest rates in Singapore. Banks and finance companies also provided relief relief for individuals and small and medium-sized enterprises through the deferment of payment and interest, payment moratoria. These are right now until the end of the year in Singapore. And similarly, insurance companies have been providing relief for individuals and SMEs with difficulty paying the insurance premiums. But I'd like to also mention that Singapore has had a strong focus on fintech, and in the crisis has produced another support package of 125 million dollars to strengthen fintech capabilities in Singapore. The upshot of all that is that financial conditions have eased almost back to pre-COVID-19 levels. This is our financial conditions index on the right-hand side. You can see this sharp tightening of financial conditions in late March and early April, but we are back to almost neutral levels, and that's, of course, supportive for the economy. Briefly, a few words on US dollar funding, because in the tumultuous days of late March in financial markets, that was a big concern that US dollar funding for non-US banks and corporates was getting expensive. And this is important because the US dollar remains the dominant currency in international trade and investment. That was an issue in Korea for the Korean won, but also, as we see here on the chart, for Sing dollar. This chart shows one way to look at the cost of US dollar funding for non-US corporates and banks, which is the cross-currency basis. The lower the line here is, you can think of it as US dollar funding being more expensive. That issue has been mostly solved and is not a big pressure point, thanks to a very fast policy reaction by policymakers across the world, and most importantly, the Federal Reserve in the United States. The Federal Reserve acted very swiftly in providing additional central banks with US dollar swap lines. Singapore, the monetary authority of Singapore, received a swap line worth 60 billion US dollars. And of course, the Bank of Korea was also a central bank that received a US dollar swap line. And that then allowed the monetary authority to provide ample US dollar funding for all banks in Singapore. This brings me to the end. I spoke a lot about short-term developments, but let's try to look a bit ahead. This is difficult because uncertainties are exceptionally high. There are, of course, uncertainties around the pandemic evolution. There's always the risk of second waves of the virus. The international situation remains very fluid, and that is important for a very open economy such as Singapore. Also, external demand, of course, took a global hit, and that matters for Singapore a lot, given its dependence on external demand. And value chains globally are in the process of being readjusted. And the big elephant in the room, of course, are geopolitical tensions between the US and China. And given that Singapore is trade dependent, it is very involved in global supply chains and is an enabler for also global supply chains on the services side. There's a headquarter for multinational corporations. This is a big risk for Singapore. Inequality is an issue in this crisis for all countries because poorer segments of the population tend to be harder hit. White-collar workers can work remotely. In many of the jobs in the services sector, that's not possible. On the upside, Singapore has a track record, as I mentioned, of maintaining social mobility, so that's encouraging. There have been pockets of high leverage among some firms in Singapore that could weigh on the recovery. We have payment moratoria in Singapore, as I mentioned, but of course, principal and interest continue to accrue. And some sectors may take a very long time to get back to pre-COVID-19 levels. For example, anything tourism and retail related. Plus, there might be structural changes and we might never get back to pre-COVID-19 levels in some sectors. But let me finish my presentation and wrap up on a positive note. I think Singapore has substantial strengths that help it get through this crisis and even perhaps see some opportunities. I mentioned the substantial fiscal policy buffers that Singapore has, and it has drawn quite substantially on these buffers already. If needed, there would be space to do more. Also, Singapore, prior to COVID, has had a strong focus on raising productivity, on turning Singapore into a global innovation hub through incentives to automate and innovate. And I believe that this crisis is accelerating some of the long-term trends towards technology adoption that we've been seeing. And perhaps we folded a few years of developments into just a few months. And a country like Singapore that has a strong focus in these areas might, in the long term, be able to capitalize on these developments. And finally, the authorities in Singapore have, over the years, had a very strong focus on upskilling the workforce. There have been very active labor market policies. There's been strong investment into human capital, not just at the university and school level, but also continuous lifelong learning, upgrading of skills in the workforce. And the authorities are now in this crisis are doubling down on these measures. So hopefully in the long term, that will also pay off. Let me end on this positive note. Of course, Singapore is very hard hit, but the recovery seems to be underway. There are large uncertainties, but hopefully we will get out of this crisis. Thank you very much.
Good afternoon, everyone, or good morning, depending on where you are. Let me also first thank KDI organizers for this very interesting workshop, and also for the opportunity to present something on the Philippines. In my presentation, I'll focus on three sets of issues. As a background, I'll begin with a pre-pandemic economic performance and policy initiatives in the Philippines to set the stage. I'll then talk about the impact of the pandemic, authorities' policy responses, and economic outlook going forward. And in the last part of the presentation, I'll share a few thoughts on economic recovery challenges and what policy priorities might be needed to address these challenges. So let's now first look at the pre-pandemic economic performance. As many of you probably know, that the Philippines economy has been doing quite well prior to the pandemic. And the IMF has often said that the Philippines economy is one of the fastest growing in the region. And as you can see on this slide, to the left, you see GDP growth was rising over a long period of time. In the last few years, annual growth averaged around 6.5%. You know, the historically high levels of growth in the Philippines for a long time. If you look at the next panel of the slide on inflation, you can see inflation was brought down, you know, quite considerably from relatively high levels. Inflation rate now is around, you know, 3%, which is the middle point of a target band and a inflation targeting framework, which was used in 2002 in the Philippines. So that band is 2 and 4%. Right now, inflation is around 3%. The last month's inflation is 2.7%. So the upshot is inflation brought down and become fairly stable. Next, you see unemployment rate have been declining consistently. In 2019, it came down to about 5.4%. Again, very good long-term performance. The next thing I would like to mention is the public debt. You see this in the last panel of the slide. Public debt has been brought down continuously. In 2019, it was just under 40% of GDP. Remember, this level is significantly below the emerging market average, which I think is about 53% of GDP. So the Philippines have, built a strong macroeconomic fundamentals through strong growth in the economy and employment. Not shown on this slide, I probably also want to mention that the Philippines has over time built a very high level of foreign reserves, which now covers 7 to 8 months of import, which is a quite high level, as you know. The country's banking system has been well capitalized and liquid, and the financial market is deepening and become more inclusive through application of digital technology and so on. The Philippines have done very well, not in terms of economic outcome, but also in terms of policy reforms. These slides list some of those achievements in terms of policy initiatives. Over the last few years, the authorities have been undertaking a massive infrastructure investment program. As you see on the right-hand side of the slide, infrastructure investment, that is, as percent of GDP, have been rising continuously from somewhere under 3% of GDP in 2015 to nearly 5.5% of GDP in 2019, a quite substantial increase. In addition to this heavy emphasis on improving infrastructure, there have been initiatives to reform tax systems, broadening the base of VAT, trying to streamline the corporate income tax rate, and reducing or at least streamlining the fiscal incentives for investment. These have been ongoing for several years, and the momentum is still there, and the authorities are pushing hard lately, trying to streamline the fiscal incentives for investment. There have been also many efforts to improve the ease of doing business. Probably seen reports suggesting that the Philippines' ease of doing business indicators compiled by the World Bank improving. This was done through various initiatives, including a very important initiative of setting up an anti-red tape authority, trying to reduce red tape and reduce procedural burdens on businesses. Finally, I just want to mention one more reform initiative, which is the trade area. As you probably know, the Philippines imports a lot of rice, even though it's a large rice producer as well. In the past, there were quotas on imports of rice, and that kept the domestic price of rice high, and also often led to volatility in domestic prices. The authorities took action, converted the import quotas into tariffs. That move not only brought down the prices, but also made the prices more responsive to market conditions. As in many other countries of Philippines income level, rice consumption, as you know, is an important part of the consumption basket. So reducing rice prices is important to improve living standards, but also keep inflation low. Of course, there are challenges remain. As you may have heard or read, Philippines still have relatively high levels of poverty. Income inequality is also relatively high. I mentioned infrastructure is a big area for improvement. There are also issues of, capacity of public investment, and relatively high level of restrictions on foreign investment. All these need to be targeted. But overall, I want you to take away this key message. The Philippines has, over the recent years, built strong macroeconomic foundations. It has built a lot of policy buffers, and the economy had a strong momentum before the onset of the current pandemic. Of course, the COVID-19 has caused a major upset to the momentum I was just talking about. As in many other countries, let's focus on the GDP. Growth has slowed down very sharply in the first half of the year. First quarter GDP contracted by 0.7% year on year. And that translates into over 5% quote-unquote sequential contraction. Second quarter GDP growth was, of course, much worse, as many people had expected. This is because that the main quarantine restrictions happened began in mid-March and last for a number of weeks, and that caused major supply side disruptions. So the economy has certainly suffered quite substantially. The second quarter growth, I believe, is the worst quarterly growth since 1981. Quite discouraging. The MF team forecast in June World Economic Outlook that the Philippine economy would contract by 3.6%. This forecast now looks a bit optimistic. I'm sure we will revisit this number during the October round of deal. With a contracting economy, as you would expect, unemployment has risen. In fact, very sharply. The number I have is that in January, the unemployment rate was around 5 and 3%. By April, it shot up to 17.1%. There are some private sector surveys suggesting that the unemployment rate may have even gone up. The situation has deteriorated. In addition, many corporates are under financial pressures, especially small and medium-sized enterprises. Again, there are a number of surveys indicating a lot of these small firms are under pressure. There was a survey done in early April indicating that some 60% of the firms, large and small, ceased operation. Many are deferring their debt payments or tax payments to keep themselves afloat. So enormous pressure on these firms. In terms of next year's growth, as many speakers have pointed out, this is going to be very difficult to forecast. In June, World Economic Outlook, the fund team forecast the economy would rebound by 6 and 8%. Again, given what happened in the first half of the year, number will probably need to be revisited. Now, to recap, the economic impact of COVID-19 in the first half of the year was significantly larger than many had expected. Moreover, it expected the impact of the COVID-19 will probably last longer than many have initially thought, as quarantine restrictions turn out to be needed for longer. These quarantine measures, of course, are necessary, but they led to major supply side disruptions during the first quarter of the year. Now, based on the current dynamics of the virus infection, it looks recovery is slower as social distancing requirement will be prolonged. And as shown in the last couple of weeks, localized periodical tightening of quarantine restrictions may be needed to contain virus. In addition, as many speakers have spoken, the external environment seems to be very difficult for countries in the region, and the Philippines is no exception. Even though some might think the Philippines economy is relatively close compared with Singapore or Malaysia, but one also has to remember Philippines economy is very open in many other respects, such as remittances and BPO, the business processing process outsourcing activities. So it's quite, in a sense, vulnerable to external shocks as well as in other countries. One other thing that you have also heard from other speakers is this scarring effect. Again, this is a quite significant issue in the Philippines case. I mentioned early on, a lot of small, medium-sized enterprises are facing a lot of pressures. If they go bankrupt, this would have seriously diminished economic activity over time, but also, risk having workers losing their work skills, causing loss of human capital. And let's not also forget that the schools are also closed. Education has been disrupted. And this may also cause, over the longer term, slow accumulation of human capital, potentially reducing growth. So the upshot is the recovery is going to be a slow one. We have to address the scarring effects on the economy, trying to restore growth potential. Let me now quickly show you some data on the virus situation in the Philippines. I just want to give you a snapshot of what's going on right now. I'm sure many of you are probably following the situation closely. As you can see on this slide, the curve, the blue curve, as you see there, is sort of a total confirmed case. This is a cumulative. You see a curve that is still rising very sharply. That, of course, means the curve has not flattened. Right now, we're talking about new confirmed cases. well over 4,000 a day over the past week. So the situation is still quite concerning. There's still quite some way to go before we see a flattening of the curve. The good news is that, as you see on the right-hand side, the authorities have ramped up the testing capacity. Right now, the daily test of individuals is somewhere around 30,000. I'm sorry. This slide is slightly out of date, but the latest report suggests that the test capacity is around 30,000 a day, roughly. The authorities are now focusing on increasing testing capacity, but also tracing of cases, isolate them, and beef up treatment. A lot of efforts are going on. Now, let me turn to policy responses in the Philippines to the COVID-19 pandemic. I'll start with fiscal policy. As you can see on this slide, let's begin with the left-hand chart. There you see a increase in general government balance. The negative means deficit. Of course, the increase across the board in deficit across the countries. You see there in the Philippines, there's a substantial increase in general government deficit, meaning the loosening of fiscal policy. In fact, you also see comparison with GFC, global financial crisis policy responses. In all the countries listed there, the responses during this episode of pandemic has been much larger than during the GFC, substantially larger, in fact. Turning to the left, right-hand side panel of the slide, this shows the discretionary policy response by the government. There you see, in terms of comparison, the Philippines, the magnitude of Philippines' response has been on the lower side, over 2.2, over 2%. I think it's 2.2% of GDP. Again, substantial, but not outstanding in the region. So even the relatively, if you like, constrained responses, what are the priorities for the authorities? How the authorities have prioritized their fiscal responses to the COVID-19 situation? The first thing to note is the authorities have focused on save lives and protect livelihoods. And given the resource constraints, the focus has been on the medical service sector. Considerable resources have been devoted to increase the capacity of the sector to deal with the pandemic. These include, of course, purchases of PPEs, increased health insurance coverage, increase or introduce financial assistance to frontline medical workers. All in all, around a little bit over $1 billion has been devoted to the medical sector, which accounts about 0.3% of GDP. Next, the government provides a substantial amount of direct income support to low poor households, which is numbered about 18 million. The mechanism is through a direct cash transfer of anywhere between 5,000 peso to 8,000 peso, which is around $100 to $160 per month. This, of course, given the situation, is a big help to these poor and low-income households. The government has also provided protection to vulnerable workers through subsidies, wage subsidies. This again amounts to about 0.3% of GDP. The other measures that the authorities have taken, including credit guarantee, which amount to 0.6% of GDP, to help small businesses and support the agricultural sector. In terms of monetary policy responses, the BSP has acted very timely and forcefully. As you may have heard, that the central bank has cut the policy rate by 175 basis points so far this year, one of the largest reductions in policy rate among emerging market economies. In addition, the central bank has cut the bank's reserve requirement ratio by 200 basis points, injecting a considerable amount of liquidity into the financial system. The BSP has also reportedly bought a large amount of government securities, mostly in the secondary market. According to Bloomberg, 45% of government's MX borrowing was bought by the government as of end July. So this provide a large financing to the government in dealing with the COVID pandemic. In addition, the central bank has provided regulatory reliefs to the banks in order for the banks to lend more to the businesses and reduce debt service burdens for businesses and households. Let me now turn to the final part of the presentation. I'll basically share a few observations on the recovery challenges and the policy priorities that might be useful in thinking of how to tackle the issues going forward. The key issue now is that how we're going to address the scarring effects, make the economy recover faster, will address some of the longer-term development issues in the Philippines. As you know, the economy has been gradually reopened, and there's now a competing demand for addressing the virus, but there also a need to protect livelihoods to reopen the economy. So there are some tensions. Although in general, if the health situation get under control more quickly, that would also support the economy. But there is, given the resource constraints, given the strains on the economy, there are some trade-offs in my view. So how to address the scarring effect? Well, keep in mind the long-term development needs of the country is an important consideration going forward. In terms of addressing the challenges and for recovery, the first thing that came to my mind is how to strengthen social protection at this time. I mentioned early on there are temporary income support, but these are being phased out. The Congress is now considering a second package of support. My sense is to support these households, but also to support the economy, to support consumption. These type of a cash transfer program need to be continued or need to be extended. So I'm quite pleased that the Congress has been considering this. I think it passed both chambers of the Congress. It should be approved hopefully soon. In addition, there could be consideration given to the existing conditional cash transfer programs in the Philippines. These programs have been shown by the World Bank and others to be quite effective in reducing poverty. So this program could expand it to help alleviate the pressures on households at the moment. The second issue that I'd like to mention is how to reprioritize infrastructure investment. I mentioned there's been a massive infrastructure investment program. Some of the programs may have to be reprioritized. Thinking in terms of addressing both the immediate needs and the long-term needs, there could be reprioritization towards the program or projects that are already under construction, projects that are related to building up the digital economy, given the increasing demand for work from home. Also projects that are probably of maintenance and repair nature, so that more jobs could be created in the short term. Third issue has to do with the small businesses. I mentioned that a lot of them are under pressure. How to support them is going to be very important and will determine how fast the economy will recover and how quickly more jobs can be created. The government has, I mentioned, provide lots of support, but given the protracted impact of the COVID-19, the outcome we see in terms of growth, there may be more support needed to give these small businesses additional boost. Again, this has been considered in the Congress in the second, what they call the Recovery as One bill, and hopefully more assistance will be approved to help these small businesses to recover. There are many more issues, but finally, let me just mention one area. These are the issues related to structural reforms. I mentioned earlier on that the Philippines had a very strong structural reform momentum. This momentum need to be kept or even accelerated, but may also need to be reprioritized as well. There was already a program to introduce national digital ID, and given what we witnessed during the cash transfer process, that authorities found is difficult to identify poor households or poor individuals. This national ID program, is very important. I know authorities are trying to accelerate, and they trying to they targeted to finish it by October. And if that's done, it'll be a tremendous help in this regard. Let me also just mention tax reforms. This is, again, very important. Important in the sense that it will allow the authorities to raise revenue over long term, but could also provide a boost in the short run to business sentiment, provide relief on tax burdens through corporate income tax reduction. Finally, let me mention one more thing. The FDI, for a long time, the Philippines had a relatively moderate level of FDI inflow compared with other countries. Substantial progress was made over the last few years, but there are still relatively high restrictions in the Philippines compared with many other countries. So further relaxation of FDI restrictions would help recovery in investment and help the overall economic situation. So with that, I'll finish here and happy to take questions together with Jochen. Thank you very much.